Hi, glad to be back. Is anyone joining us today? Planty here, willing to hear lots of questions. I haven't spoken to you for a while, had a lot on. What shall we start with? So we're coming up to the end of the year. We're coming very close to a seasonal period where people start buying equities in a big way. The charts seem to suggest that we've got just probably one more little low on all of them in the US just to kickstart things. It's been tricky, hasn't it? The last few sessions. I want to look at what's been going on in terms of lack of breadth. Everyone's talking, I don't know if you've been watching, but everyone's been talking about the market in December having really negative breadth, which is often associated with big sell-offs to come. But underneath, there has been quite a lot of concentration in the tech stocks again, the FANGs really. Hello, Garba Mohammed, watching from Nigeria. Welcome aboard. Ask away. So the old FANGs, when I first started looking at it, was the Facebooks, Alphabet, Amazon, Netscape, and all that stuff. But it's been expanded. The New York Stock Exchange FANG index on ICE has all these stocks on it now: Meta, Apple, Amazon, Netflix, Microsoft's in there, obviously, and Nvidia. The only thing missing is Tesla, but they've got some interesting ones here. ServiceNow, CrowdStrike there on the software side, cybersecurity. ServiceNow is basically AI bottom up. I talk about it quite a lot. So what's been going on with that stock does prove that there is mega interest in business usage. It's been absolutely crazy stock. And then Broadcom, which we saw rally massively last week on results, and they are networking and AI networking, etc. So that has become quite a useful index to watch. And yeah, this is the chart that the media are focused on. New York Stock Exchange AD, and this is the actual chart of the differences. So what is the difference between advances and declines on a daily basis? Now they're all saying it's been down every day. It's closed down every day apart from one, but they've all been around zero, and most of them, as you can see, have closed below. So they are correct that the market have kept ticking off new highs on very low volume. We're in consolidations, but this is something which is often associated with big pullbacks in the weeks to come. We may well see that, but in the short term, why has it been happening? Well, really, it's all to do with the FANG index that we just mentioned. Look at that, that's up 11 2/3% in December itself, being up nearly every day, most of those days, and 1, 2, 3, 4, 5, 7 days out of 10 trading days, really. So the bid is there in the large stocks. You've probably been watching that. Nasdaq has been very frustrating to try and trade. All the pullbacks keep getting swallowed up, and obviously we had the update for the reweights on that, which will take place on Monday, and it's obviously got MicroStrategy going into the index, and the net of a few of the rejigs is that Apple, one of the heavyweights, will see inflows as well. So often you get a lot of advanced buying of the index going in to reweights because it's very difficult to get it all done in that auction period on the actual day. So you see people buying ahead. So there's probably a lot of program buying around, which is why often you get to each of the little 15-minute trading periods and you see another tick up on the chart and on your trends, and you know what the hell's going on. Just as it's all set up to break down, it's picked up. So it's often low volume, and as you can see, low advanced declines, but we've got concentration in the Nasdaq techie side of things. Now, another way of looking at that is relative to the index. So looking at the S&P, and the S&P equal weight, both relative to the FANGs. Look, they've put in massive outperformance from the FANG side. So we've actually got relative lows for the year on the S&P FANG index, S&P divided by FANG, which shows you that tech has become the focus yet again. And you'd be expecting that going into the Trump inauguration. So it's probably a lot of buying ahead of a lot of the announcements, and the equal weight is coming off at a similar gradient. So it's kind of telling you that the lack of lack of breadth in the market is actually taking place at the higher level in the stocks. So the S&P equal weight is the best measure for broadening, and that is struggling against tech. So there's been no real participation. Now that should hopefully come in. Hello, Planty. Welcome. Hello, husband. Buy the dip on Nvidia. Yes, it's probably the right thing. There are a few issues, aren't there, at the fundamental level short term on Nvidia relative to a few other things, just in terms of supply. But there's every chance we start seeing leadership again from that into what should be a breakout on yes, answer in a minute, Bletchley. So we're likely to have a breakout on the indices, which may or may not include the tech for now, but you'd anticipate that continues really into Trump. I think the danger for the market is when we have the seasonal rally into Q1, into the inauguration, and then as we can see, if the FANG index starts reversing, it can have a massive effect on the overall thing. And I think we've got a lot of very tricky geopolitics coming up into Q1, both in Europe and, as I've been saying, emerging markets. China itself is struggling to make a really decisive move on its stimulus and keeps trying to cheat its way through, hoping that they can talk the market up. It's not having any of it. And you've got things like Brazil that have got a dangerous parallel for the UK, perhaps, a leftist leaning government that's refusing to sort out the spending problems, etc., etc. The market's lost confidence in it. The central bank's having to throw money at the interest rates, trying to buy the real again, selling dollars in huge amounts to try and prop up the currency. And people are now selling the bonds and equities. It's very much how you can see a run starting on a country. Now, they've obviously got their own issues, but with the way China is cutting aggressively and the strong dollar, the combination of those is going to start to cause a problem in some of the emerging market areas in the start of next year. So we might start to see some macro headlines that start to get a little bit troublesome, which will be one reason why the markets may pull back. The heuristic, the knee-jerk, what everyone thinks into Trump is that it's going to be strong dollar, but as he's shown this week, it's a negotiating point. I think the whole SoftBank interview is well worth watching. The announcement, he reckons they've got lots of people queuing up to negotiate and invest in the US. So that at some point may unwind, but I think we'll need to see the actual details of that. My sort of setup is we have a rally into Q1, then we've got all sorts of angst and sideways movements for the equity markets, if not outright 10% pullbacks. And then the good data, the good read through from Trump's policies potentially starts showing its head. And one of the main reasons why that might happen is if you look at the last 3 years of going into that actual year, coming out of the bear market at the end of 2022, the forecasts were down. So the market ended up beating that. So that was a good outperformance. Last year, the forecasts were almost flat growth terms for earnings, and they smashed them. So it got called up. Now everybody has called up the growth rate for 25. And we've also had a multiple expansion, which we talked about before. So you've got earnings growing up and the multiples that you'd pay for that. In combination, that leads to big moves in indices, which is what we've seen, the 20% plus. There's no reason why that can't continue. I'll try and find that chart again in a minute. But in the 90s, you had 5 consecutive 20% plus moves before it all came out. Some people are trying to say, the last time the market had a proper crash was after the last 2 years of those 5 going into the tech bubble. So it's kind of pick your statistics, but the setup is for continued growth, and Trump is a pro-growth model. But we've just got to get through a lot of angst in the first quarter. So I say we're already priced for outperformance, so there might not be too much commitment money-wise until people see a little bit of value. So we might have to create room. We've talked about the charts at the higher level being in a 3, 4, 5 with a 3 top coming in Q1 next year. So we're setting up for a chart pullback. I'm just trying to find some fundamentals to sit with that. And then we should push on again into the end of the year with a wave 5 breakout. So what we are going to see is volatility. This year has had a lot of choppiness, but in general, where is it? The VIX has dropped back, hasn't it? Where are we? So that VIX chart that we've been following, if I can find the right one. We'll stick with that one for the minute. So that's the volatility of the VIX of the VIX, basically, which we said would end up coming down into December. That's actually started picking up slightly. So the movement of the VIX, but generally it's still in a sort of buy zone. It's gone up because we're consolidating, but the true line for this at long term is sort of 110 to 120. But it's the actual VIX I want, which is on different. Here we go. So we talked about that flip-flop in the VIX itself, and that we anticipated into the end of the year that it would come down. We wanted it to be below 16. 16 is 1% up or down per day. That's what attracts big amounts of money into the market. The panic for the equity markets is here when it's in the 20s and above. We've been talking about it fading that level into election and beyond, and that sort of has happened. We're stuck in that channel. That's worked quite nicely. It's the other volatilities we need to look at. We've all been moaning about FX volatility. Sorry, I'm just distracted by the comments there. What do you say, Bletchley? Was the decent run on the dollar a typical buy the rumour, sell the fact? What, in terms of the Trump thing? Yeah, quite probably. And remember we're talking about that multi-year kind of pivot point, aren't we? So that even though we're in a consolidation, it's kind of due for a rollover before it may end up going higher. So yeah, I think the run through the election was it's a lot of buy the rumor. People are just lazily saying that everything's going to be, even if you put some tariffs on, that it's going to be inflationary. Yet China's got a real issue. They're flooding Europe with cheap product. They're starting to really panic about deflation. They've thrown lots at it, and they're not really getting any consumer activity or market movement. And people are actually, excuse me, hoarding their cash, which is the dangerous thing in the deflationary environment. You're trying to make stimulatory environments, and if people don't spend, that's what happened in Japan. Then the whole thing implodes. China's desperate to pick the right moment to flood it with lots of money. So relative to America, those prices may actually get themselves through. Planty, I'm going to talk about gold in a minute, and S1R4JX. It's a lovely name. I'll name my next child after that. You're grateful for ACG, and 2025 is going to be huge. You're not wrong there. Alex has got lots of big plans. Keep your eyes out for that. What I wanted to show here, though, is the volatility on other products, which you can find on the CME page for free again. As I said, you should be using the CME and all its tools and learning tools. It's for free. It's not all about futures. It transcends the underlying markets. But what we've got here is 3 other products. We've got gold, with its volatility running at 15, which again is plus or minus 1%. Treasury vol, which was elevated into the election, which is the blue. Where are we? Which is the blue line here, and we said that should roll off along with the VIX. We've shown that the VIX rolled off, and then we've got FX vol, which has been pretty dull most of the year. We had a little bit of volatility going in, and it's again drifting back. So all these vols are drifting back when historically they've had much higher peaks and generally stayed higher for longer. I think that is the point that's going to come back in 2025. We're going to see a lot more volatility, so we'd expect the move index to move back towards 10, FX possibly moving up to 10, because the whole European thing, as I'll show in a minute on the EU chart, I think there is a danger with everything that's going on in Europe that at some point there will be a parity test, which it probably bounces off. But I think that end game has got to come, and I think the way that the oats bun spread is set up, that's looking a little bit like a barrier triangle. They normally finish with a breakout through the flat line, and we'll have a look at that in a minute. But net, I think the FX volatility as a result will start going up. The EU is a massive part of DXY, remember. And then gold again. I do want to talk about gold, and I want to talk about gold in terms of what's going on in Bitcoin as well, because I think that is very important. And you may or may have not kept up with the details, but the US have got something on the statute bill which is quite dangerous. They actually might be leading the BRICS into it. They might actually be preceding the BRICS in the sort of return to gold standard in effect, but in a way of backing Bitcoin. It's all a bit weird, but I'll run through that because I don't think the market's talking about it enough. What else did I have on the sheet? Nothing on there. So actually, we'll jump into that one now because I want to find that chart. Just give me a minute. So I don't know if any of you play crypto or Bitcoin. That's been going crazy. I've been writing a note on Bitcoin, and there's all of a sudden a massive acceptance in the mainstream to consider. Well, obviously the ETF, spot ETF, was the massive deciding point, but I don't think everyone's realised just quite how much money there is to switch into Bitcoin, just as a diversifying asset, just as an inflation hedge, because everyone talks about the volatility on Bitcoin, but it's had mega outperformance. So I'd say its average performance is 40% per year, and so is its volatility. So that means its risk-adjusted rate of return is around 1, a Sharpe ratio, which is similar to the S&P performance. So all of a sudden people look at it and go, actually, it's not quite as scary as it looks. Let me see if we can get this chart on the share. So if you can see that is Bitcoin is now at $2 trillion with it being at $100,000. Gold market generally it's anywhere between 16 and 21 as it shows here. I've seen as a valuation. Let's just take this as read. The key thing is people like Fidelity have put out some very good charts that the addition of the Bitcoin value plus gold tends to add up to the US M2 money supply. That's the one that's really been enlarged, starting to look at broad money in the US, out of control, printing money to pay for the budget, etc. Now, if you look globally, there's similar things happen. There's lots and lots of money being printed. So money supply is 105. So they've shown that gold plus Bitcoin is equivalent to the current US M2 figure. So that's kind of in line. So if the globe all of a sudden starts to adopt and think that it's a good hedge to have Bitcoin and gold, which we talked about gold as being the potential revalue asset, if Bitcoin is going to see inflows as well, the combination of those two at some point will approach 105 trillion, which on the basis that Bitcoin is at 2, say they just go up in line, we'll be looking at sort of 4 or 5 times the price, just as a proxy. So that would get you to 400,000 or 500,000. But it may be that Bitcoin overtakes gold in the mix. And in any case, look at this, there's 322 trillion outstanding debt across the world. Many people are eyeing up ideas of being able to write off debt with what may be seen as a massive uptick in the valuation of Bitcoin. So there's a chatter that people want to try and create reserves. But that is something I really want to look at, because Trump doubled down on that in that interview with Jim Cramer at the stock exchange last Friday. That was mentioned over the weekend. And he said they're going to do something great. Now, the only statute that is on the board at the moment is the one proposed by, where's she gone? Here she is. All right, let's share this. Liz Cummins in July proposed the aptly named Boosting Innovation, Technology and Competitiveness Through Optimized Investment Nationwide Act, which is the Bitcoin Act. It's a bit like they use Doge, they did Bitcoin here. So how many of you are aware that that is on the statute books already? They've talked about in the US, Trump, etc., becoming crypto positive. Well, if this is enacted, there's going to be huge ramifications across the globe, because the detail in it, as I said, go whenever these things are discussed, go to the websites and actually look at it. This is very interesting. So that it provides for buying Bitcoin, right? The idea is that they buy 1 million over 5 years with a maximum of 200,000 per year, and they must hold them for 20 years unless they're used to retire outstanding federal debt, try and bring down the national debt, blah, blah, blah. So it's directing the Treasury to set up a strategic buying reserve. Across the US, existing Bitcoins must be transferred to the reserve. So that's the stuff that they have confiscated, etc. And other states may voluntarily store, and there are a couple of bills that have been put forward. Texas, in fact, put forward a bill where they're asking people to voluntary donate their Bitcoin so the taxpayer doesn't have to pay for it. But this main bill for the federal level is to actually purchase them. That reduces the total amount of US dollars banks may hold in surplus, blah, blah. So that's just a summary. But if you actually go into detail, it's quite scary, really, if I can get into it. Here it is. So talk about summary of why they're doing it, blah, 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 what it all means. But some very key details in it. So that once they've spelt out how many you can buy and how long you're going to hold it for, they go into how they're going to pay for it. Right, it's hidden here in the, let's offset the cost of the strategic Bitcoin reserve. So what they basically said here is that whenever the Federal Reserve Bank is in profit for the year, so they'd normally make a deposit with the Treasury, the first 6 trillion of that would be handed over to the Treasury's Bitcoin buying fund. And so where they're going to get 6 trillion profit from? Well, here it comes, gold certificates. Right? If this act gets passed, within 180 days, each federal state bank, Federal Reserve Bank, will have to tender its gold certificates to the Fed to the Treasury and be reissued with a mark-to-market gold certificate. So as you know, so they're probably valued down at, let's say, $100, and we know where gold is at the moment at 2,700. They're basically making a implicit kind of gold standard out of their holdings to create. So this is like QE on steroids, but for Bitcoin. So it's suddenly going to create that would create about $6.8 trillion of buying power instantly for that Treasury buying fund to go out and try and buy up Bitcoin. So obviously they're trying to buy 5% of Bitcoin by trying to get to 1 million bits after 5 years. Now, I don't think the rest of the world is going to stand by and watch that happen. So you've had Russia have come out and said that they think crypto is sort of dollar agnostic, can't be controlled, and they're looking at setting up a reserve. Putin's already passed a law that allows crypto to be used as property against overseas transactions. So maybe the end game that we've all been talking about with the whole gold thing is to revalue the gold reserves, like we said, and the level is to be determined. Nowhere in here does it say actually it has to be done at today's spot. The market may get ramped up in gold as a result of them doing this. So it could end up anywhere. So in which case you've then got more self-fulfilling buying power to keep buying the Bitcoin. So God knows what China are going to think about that, and whether it all feels to me like there's big collusion, which is why I did that meme the other day with them all chatting to each other about what they're going to do. Xi, Putin and Trump, because all of them are in massive debt that they need to pay off with some kind of miraculously created revaluation reserve. We've talked about before how you can do that with the gold, and which is why going back to a gold standard would be an issue. But this has actually got an actual purpose for them doing that and involving Bitcoin. So maybe this is the end game. It's to buy Bitcoin, ultimately the thing that can't have the supply changed, and in which case it's much easier to define and squeeze the price in. Whereas with gold, you've got lots of other things going on. What does that mean to gold? Does gold collapse, or does it mean that there's now an incentive to make gold stay high? Because if you lock in the price, there's no point winning in Bitcoin and then losing in gold. So there's an incentive again for the central banks to keep buying gold, and it's also a diversifying hedge in case things go wrong. So I think this is one way of ramping the whole system without necessarily seeing gold smash. So that's got to be in the background. I think in the short term, people are interpreting it as the whole focus on Bitcoin as being a distraction from gold buying. But just I'm saying, just be careful. I think they're all interrelated. And at some point, once the discussion gets to using the gold holdings like this, you're probably going to see this is going to be the reason why gold goes into that next super buying phase. When you could go 3,000, 5,000 plus, So that is a bit of fundamental background, which you may or may not be aware of, but I think, as I've always said, it's important to go into details. I didn't realize that was being suggested when they were talking about doing a Bitcoin reserve. Hugely important, and it should be spoken about every day. I know Bill Dudley and Bloomberg have criticized the use of or the usefulness of having the Bitcoin reserve, with Dudley kind of talking about, there's no exit strategy because once you've moved Bitcoin up, you can't really sell it. But he should know that it's been done before. And the fact you've done QE to such an extent, you can create revaluation reserves and offsetting liabilities at any point, and then it's just a case of what you write off with the positive side. It's known that can happen in the gold market. That was always the idea in the background. Anyway, a bit of background reading for you to get involved in, but I thought it was interesting. So in terms of gold itself, I still think we're in a bullish setup for a breakout to new all-time highs. It's just a case of how we get there. As I said yesterday, we had the chart yesterday, which we'll go through now. So this is what I sent around today. And I said yesterday, this low here, which is now marked up as a W, as part of a WXY, So we've now got two lots of ABC sell-offs, two lots of three waves is what we're kind of anticipating, which means what yesterday we're hoping would hold, and that was the actual wave two pullback. We broke that low. So I said, it's not necessarily overly bearish, but it just means that the pattern could change. Now, again, we've got a setup here where this is a three-wave pullback potentially, or it could be easily seen as a five-wave, in which case it's start of a zigzag of 5, 3, 5, and they generally double in the third leg, but 61.8 is the second most popular move, and that would keep the entire 1, 2, 1, 2, 1, 2 structure still valid. There'd be no break with the bottom. So that's the most bullish setup, is that 2 bottoms out around the 61.8 fib, which is 26.13, and I know a number of you have got that kind of zone in, and it's a much stronger order block support, isn't it? Very much repeat buyers at this level previously. And again, even if that breaks, we don't necessarily have to be thinking we're going to the end of the world. This equal legs for the WXY, which would take us back below 2600 and would break the previous wave 2 low, may just be an extension of that at a high degree. It still feels like we are just cementing the move up from the 2520 lows. So 2520 is the thing that has to break to change the bullishness. This very much could be the one being consolidated with a down, up, down, 3-wave swing, and then we bounce again out of the sub 2600 level. But at the moment, I still think, and with the seasonality as well, and obviously once the tech markets break out, I think if we're back into a risk-on scenario with the dollar sorted out, then we should go. I think the problem we've got is we've got to get through tonight, and a number of people might not be up to speed with what the Fed are going to do. And the Fed, obviously, it's a given they're going to do the 100%. The 25 basis points, that's almost 100%. We know that's going to happen. Lots of the talking heads at the Fed have been wanting to talk about pauses. That's in the frame. And it's all about the dot plot. Now, Goolsbee has been sent out a lot to chatter on Powell's behalf, and he's tried to make out that there's nothing really happened to change the idea of the September one. But that's still got 100 basis points to come off by the end of next year. If that's the case, the market is pricing in less than 50 basis points. So just like the market was ahead last year and the Fed were catching up, at the moment it looks like the Fed are ahead on rates and the market is behind. But at some degree, that's going to get changed tonight. I'm sure there's going to be chatter about the change in dot plot. I think the way to get the rate cut through tonight, and Powell will have been speaking to everyone, is the fact that, and they've obviously been sat together in a room, but he rings them beforehand, is that they'll vote for the rate cut on the basis that they pause. They all want to have a look at the data. So that puts us into consensus of January being a pause. And then it's a case of who's right. Is it 2? Is it 4 rate cuts, and at what speed? But that, to me, suggests that the dot plot may well come out with either a 1 per quarter and nicely spread out, sort of staying in line with September, and suggesting looking at the next cut at the end of the quarter. Or a lot of them actually say they don't think that they see a need for justifying much more than 50 basis points anyway to come in line with the market. But either way, unless people have been completely asleep, there's going to be a correction to that dot plot, I think. And the rhetoric, it's all about how Powell sells it. And I think he's going to, because of his standpoint and being quite dovish, he's going to talk about still being too tight, and that they'll be looking to equalize that when they can, but it's appropriate to take a look back at the hard work that they've already done. It'll be something like that, complete fudge. And that might just be enough to get a temporary little squirt up in the dollar for those that read the language super negatively, blah, blah, blah. And that should hopefully be enough to help put in the absolute lows on the equity markets, the top on the dollar, low on the euro, and then we can move forward into the end of the year, and into inauguration mid to late January. But let's say a lot of people will be literally waiting to see the text before they allocate. But outside that, I do think it looks like there are some program trades around in the thin volume, just by the nature of how the markets are trading and how they're trading pullbacks. They're just bouncing off levels at regular intervals, which if you know anyone that programs the algos to do program trades, VWAPs over the day, then there are fixed profiles when you should be trading. And for people that do the tech but don't necessarily do the actual physical trading, they find using the clock much easier than anything super technical. So that's often why you see big movements every time the clock spins to the quarters of an hour. So any comments out there on what people are thinking on gold, on rates, on interest rates, blah, blah, blah? You're all very quiet today. Have you been getting on anyway? December, tricky month. Is there anything you're playing, want to look at? So I still think gold, once we settle down, the next leg up, if I'm still correct, if it's a series of 1-2s, the nesting that we talk about, then we could have a breakout, all-time highs, maybe touch 28 even by the end of the month, given all the chatter. It all depends on, Bitcoin, blah, 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 the whole idea of everyone chasing it. It's a great idea, but it might start making people think, oh, dangerous, we're playing with fire. If they're not reining in the spending, we're still on the end of the dollar nonsense, the whole de-dollarization. I'd like to try and find this other chart. I know where it is. Furkan Saeed, hello. How can we help? Yeah, let's look at this. Hello, Billy Bock Botond. Nice of you both to join us. Right, so this is Bitcoin ownership distribution. So I said that ETF came in 1.25 million Bitcoin versus Satoshi's 968. So all of a sudden in 6 months, lots of inflows from mainstream. Government's still really small and they're all over it for getting involved. Lots of individuals dwarfing the actual mainstream actors. Lots and lots of people are looking to come in, local and national governments, as we discussed earlier. Actual treasury departments at big companies, Apple, they've got hundreds of billions. And Bitcoin really has been the only asset that's out. Money supply has been going up at 7% a year, monetary inflation. S&P is the only way of being able to outstrip that. And gold kind of in line. They're both kind of just in line with actually making real returns, whereas Bitcoin has outperformed net by about 7% per year. So all of a sudden, treasury departments are thinking maybe we should be investing in this. And I've said the actual Sharpe ratio, even though it's got big volatility, it's got big returns. So they're realizing that they can sell that as being just as safe as being in the S&P and in gold. There's reasons to diversify treasury holdings. So even Apple have lost something like 15 billion in real terms in the last 5 years just from holding cash and stuff like that. So you'll see more and more of companies, and you've seen Amazon and Microsoft shareholders trying to get the company to vote on whether to invest in Bitcoin. I think Microsoft turned it down. Amazon are at least investigating it, and they've got an AGM in April where they may make a decision. So net, this percentage spread is going to change in Bitcoin ownership. They're going to come in for it. And look, 900 trillion is the value out there of all different areas that you can invest in. Bitcoin's only at 2 trillion. And you've got all these actors trying to suggest that you should be buying into it, and they are going into it actively. So you've got ETF money going in, and the UK haven't even permissioned ETFs yet. You've got governments and you've got companies, you've got investors suddenly thinking, I want to get a piece of it. So there's no way that's staying at 2 trillion. And we've showed why, along with gold, it's going to match money supply at least. So I think gold continues to go up because you've got the central banks can literally hold it as a reserve asset. Bitcoin hasn't got that status. It'll take a long time to get that until all the regulations are passed, but that will come eventually. So then you probably have dollar, Bitcoin, and gold all available to be deemed to be reserve assets. But that they're probably going to try and get Bitcoin to match gold, and then the gold bugs like China are going to try and make gold run away from it. So it's very easy that you're going to end up in here with both gold and Bitcoin, much more like 50 to 100 trillion out of this, probably in the next 10 years, which is why fundamentally you play the longs. Anyway, I just like that chart. It shows you picture. I love the way you got the blocks relative, just shows you how everything for the future is out of kilter with where it's likely to go. This is the one, real estate is the one that has potential for going back a little bit. And bonds, again, the mixture of those two for what's deemed to be safe returns. That might be a feature of the day. They might see more volatility, but as a result, in which case you might see people exiting those for what they deem something safer. So, Gabra, have you been watching the whole episode or not? So, just along from what I've just been saying there, that you've got to think of Bitcoin in terms of its asset valuation share as opposed to just price. The price is going to be fixed with whatever the valuation of investment that goes into Bitcoin, it's divided by the whole thing to be completely altruistic, 21 million, but you do it by 20 or whatever to make it easier. Then that is what the price is going to be. So at the moment, 2 trillion divided by 20 is 100,000. So Bitcoin, if it just went equal to gold at 18 trillion, that takes you to 800,000. People are suddenly looking at it as there are mega reasons why people are coming into the area. Now, Bitcoin is therefore, it's the store of value, the digital gold idea. It's always going to be at the top end of the market. I think of the whole eco structure below that as being a little bit like the IPO market. This is ways of creating value in a digital world for the future. So these things are valid, and it all depends on the viability of what that actual altcoin is, or cryptocurrency, what it's covering, whether it's just supposed to be slow or quick, whether you're doing it on Taylor Swift or on Luigi the Murderer, which I don't like the look of that. But in any of this, it's a way of crystallizing value of things, whereas Bitcoin is going to be deemed to be a store of value. It's going to be taking on a kind of reserve status, and people are only just catching up with the fact what it actually means, the whole crypto support from the US. And they're doing it because they know that Russia actively have already started moving ahead of them on a legislative reason. So hence there is a massive demand coming into Bitcoin that probably wasn't there before. So it may well reduce the volatility. People are going to look at it and think that this is a case of a massive demand that is going to struggle. The amount of Bitcoin on exchanges is a really exceptional low, isn't it? People have put it in a lot into cold storage. The number of wallets above 10 million, the really long hodl accounts, isn't moving. It's the only ones that have been selling in the sort of 5 to 7 years, and they're finding ready hands. This market's going to move forward with the fact that there's going to be really limited supply of what's out there, with a lot of people chasing it. So I think all of a sudden what was deemed to be an asset that isn't really going to be very volatile price-wise after the big move up it's had, suddenly has the potential to be a multi-bagger again. and it's being considered by mainstream rather than talked down. So that's what I think is going on. That is a good point, Billy Bot. Not enough people talk about that. Quantum computing, I find it hard to imagine the Bitcoin network won't be hacked in one way or another. Now, yeah, but there's probably ways of coming around that, because the security of the Bitcoin system is, in terms of the Bitcoin mining and the validating of the structure, is dependent on, it can only be broken with 51% control. So the quantum computing would have to be on its own, isolated, and I'm sure they'll find ways of being able to slow that down. That's always an issue with any investment. What you're saying there, sovereign states will confiscate individual people's Bitcoin. Well, they could do that with gold, blah, 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 but people are a little bit more savvy these days. Once you start doing that, then you will bring down all the people's biggest fear of the digital world is that will make that easier to do. But as soon as they happen, that will cause riots. I don't think it will happen. I think it is more for the fact it will start controlling fraud a lot better and bad actors. But yeah, I know it is possible, and this is why you have to be careful of governments. But it's one of the reasons why Bitcoin should actually stay central to a system for individuals, and why, because it doesn't have the ability to be controlled by any government group. It is completely decentralized. There is the ability to follow the trail of the Bitcoin, because that's how it was designed, and it has been used by the FBI, etc., to trace some malfeasance, because the whole point is you're always leaving a trail and you'll get caught at some point. Trying to get the money out of the system is the key for the criminals, but no longer is it the kind of dark web idea that they can hide away in the system. But there is this degree of no centralization control. It is open user defined, isn't it? So it's all about, to me, it all boils down to the good actors within the system, the Bitcoin miners and the people who allow the amendments to go through, the sort of OG level of overseers that put in the amendments. And that's why they've tried to keep Bitcoin fairly what would you describe it, clean, without too many amendments. Obviously there are issues with the amount of megabytes you can attach to it, but that's why things like the wrap Bitcoin idea is a good one. The fact that you're basing it on Bitcoin, but you're using other technologies for transactions. And this is why it's people's acceptance of the digital blockchain idea that was the key. Bitcoin is the value reserve part of the equation. And once people get trust in crypto as a concept, which is massively being adopted, etc., and it's been kind of adopted along the mobile phone usage growth rate, which suggests that this thing is still going to go in this S-curve kind of way, moving up, then unfortunately it is the future. So look out for this whole mechanism. We've been playing around with the gold, wondering what's going to happen to Bitcoin. Might actually be the other way around. What else were we going to look at? So that was a chart I didn't get a chance to show you. Again, with the gold, I'm sure you all heard that China jumped up in November, having not added anything from April to October. They put in 160. Was it 1.? We've got 32,000 ounces. 0.16 tons they added, which basically. No, it was 5 tons worth, wasn't it? Sorry, talking nonsense. 32,000 ounces per ton. So they added 1.6 million troy ounces to their total. And that's, for some reason, I couldn't get access to the live release on that directly from China, but people had posted it on the web. There must have been an issue with their actual website, but it was put out there, and obviously we saw the bounce. But what it does suggest is that there are buyers, there are physical buyers again in that market, and we're kind of seeing it. That supports the pullback, and it was one of the other CMEs I want to look at. Something I tried to encourage you to look at previously. So we had all these months of gold stops, because remember, 95% of gold is literally paper trading. The reason why the market has been so strong is because the buyers keep issuing stop notices onto the market. Now, what that basically means is you've got to deliver the physical gold. And we're showing that the trends were particularly high throughout the year when the market started bouncing. So you had these big months of 20,000 contracts, 20,000 times 100 ounces to be delivered. The market didn't have it. You had 30,000 in June. And then look, December, we're in a big consolidation period. We did top out, and then we've been going sideways, but people are being delivered into. So it's an interesting point for the market. It tells you that you're in consolidation because we are going sideways, literally on the chart. But we've actually found a level where people are willing to sell the gold, which is possibly why we have been seeing the fiat paper money traders manage to get it back. But be very careful here, because as soon as with that kind of physical demand around, as soon as that disappears, the market's going to squeeze. And equally, you can look at it the other way around. That amount of gold selling in the market is only in a consolidation period after moving up off the lows. Kind of tells you that there's an underlying buyer and an underlying strength. So be very careful of getting too bearish on gold. DXY itself, I said I'd like to see one more high. When we're over here, we had what looked like the 1-2 in place. Remember, one is starting from the previous X top. We should be working our way down here in what is probably a 5-3-5 formation. That has the 2 finished here. No, because it's been overthrown. So we're looking for 2 to be somewhere over here. And look, this really strong fair value gap from ages back, 18 months ago, is still actually working as an area of selling. Will that get taken out? We could still move into a break of that and fail, and the whole setup still be valid. I do think we've got one more spike, whatever, into this area before we pull back. And that should be, as we discussed earlier, the incentive for the risk assets to rally into the end of the year. Hopefully that comes with a little bit of confusion over what's said tonight. And going forward, might take just a day, or it might be into the end of the week, but then we should start moving. And that kind of is a risk asset rally into Trump's inauguration. Which, again, looking at it in a different way, but almost the same, is looking at the EU, which we've been stuck in this really meandering pattern, which we keep hoping is a low. Whenever in that situation and you're not really getting anything that impulsive, lots of overlapping, you're in a consolidation. This one, again, looks like we've probably got one more low to come to challenge that. A lower low on this pattern in 3 waves should be the signal that we get the rally to finish off what is a 3-swing classic for X with a sub WXY. Once we get that high in the euro, low in the dollar into January, maybe February, blah, 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 we've got a big chance that there's all sorts of things going wrong around the time of the German election, the whole French debacle. Do we get that challenge of parity that everyone's been talking about and hoping that won't happen? That could easily be the panic time there, just as we get some panic, and very choppy panic in the dollar. Trump in overdrive on what he's going to do, blah, blah, blah. It's going to be, there's so much macroeconomics and geopolitics coming up in early 2025, as we were discussing earlier. Lots of people around the globe have got to make their minds up what their relationship's going to be like with the US. It's going to be all over the place. It could be, but this could be a combination of positive policy, creating this inflows for the dollar. We get that dollar smile idea we talked about, which is when you get risk assets, US risk assets moving forward on confidence with people buying the dollar to buy those assets. So it doesn't necessarily have to be that a strong dollar brings the bond and equity markets crashing. We'll just have to see. But I'm leaning towards it being negative events to start with, which then morphs into people thinking, Tina, there is no alternative but to buy the hell out of the US. And that's when we've created room versus those very toppy expectations for equities we talked about at the start. So it's going to be an interesting year. It's going to be quite a choppy year. Like I said, I'm expecting volatility to increase across the board in assets. That sits with a Q1 high, a very choppy pullback in a lot of instruments, followed by a risk-on rally from probably late Q2 into the end of the year. We will develop more over the next few sessions. The next time I can get on here, hopefully I can get on again either tomorrow or Friday, and I'll have some more stuff for you. But please come on with lots of questions and put questions on my chat for me so I can have a look at ideas that you're thinking about, and we can try and pull together those fundamentals, which give us a chance of seeing which of the technical setups are more likely, and in reverse is a technical that you're looking at that you can't see through, but you can't see how the fundamentals are going to work out. And then we can try and narrow down the probabilities for what's happening. That's the power and key of trying to put these things together, and then having the alternatives in the back of your mind for what is the next best setup for that chart if it's not happening. I know a number of you follow the Dow. I still think from what we talked about in early December, late November, early December, is that was a 1 top. I was looking for that to be a 2 pullback, which would need it to be around 61.8. We got that. And then it's all about what we've had since. Now we're in a fifth wave. Fifth wave's going to have overlapping of waves, so that isn't a problem that we're still in here. The bearish case here is that this is still doing a wave 2, and it's an expanding flat. You've had a low, a higher high, which isn't an impulsive move. That would mean that the next low would have to be below this one. And that, again, would move back into an equal legs for this current bit. So that is a possibility, but I'm leaning on the fact that this is still a 1, 2, 3, and we're in a wave 4 pullback, which then goes into a seasonal rally. I'd like to see us just get a little bit closer to 61.8 fib just to make it convenient. It'd also be much closer to this area of multiple buying zones. So momentum really did bottom with the move. That would suggest we could get a low with divergence at the moment if we can get that low in sometime in the next 24 hours, and that would sit nicely for having a rally. And the only thing that is key there is if that is wave 3, instantly we want to make sure that isn't the shortest wave. So we're checking that. It's just seeing where would 100% be from the 61.8 fib. So that'd be 45.53. So that's the reason I put that in, is if you go higher than 45.53, then net we're probably going to go a lot higher, because that makes this anticipated wave 3 here in the middle would be the shortest wave. That wouldn't be valid. So that would mean that this was subwaves, of which this would be 1, 2, 3, 4, 5, and we'd be going a lot higher, which could easily be a setup to get to that sort of January the 20th kind of top into Trump. lots of people still going on about that breadth, but the S&P 500 itself, obviously relative to being oversold, etc., then if anything, it's more or less confirming that we've got alternation between 1 and 2. So the 2 wave was steep and quite quick, whereas what is probably a sub 4th wave here is being quite meandering and has taken twice as long. Now, I like to look at where we actually are in terms of that breadth, and we're looking at where's the zero line? The zero line there is 50% above its 50-day moving average, so less 12. It's quite low. The last time we were anywhere near this was at pivot points in the market. So rather than being at a turning point going down, we're already at quite extreme lows relative to the pattern for the year. And the similar thing with 200-day moving average. Look, we're not overbought by any means. Normally when we're at the tops, we're up here in sort of 70 land, just like we are up there. I think the breadth isn't as disastrous as what people are trying to make out. I'd be getting worried if stocks above their moving averages were right up here, right at the top, towards that red line, and up here in the, which is what, 70s, 80s, in terms of 50-day moving average, and the breadth was falling down. If anything, this is just people moving to the sidelines, ready to come back in for the rally. So don't be careful what you wish for when you're looking on these measures of breadth. It's a nice headline for the medias. Just another way of looking at what's been going on in the month of December. Look, Nvidia, and that must have bounced right now. Has that bounced? Because that was down 6% earlier. Sure. Maybe not. No, that was on the weekly. Hi, Poppadom. Yeah, I mentioned. I said that to me is the problem. I think people should be up to speed, but they possibly aren't. Goolsby's been coming out saying that he doesn't think there's much difference data-wise to suggest much away from the September plot, which obviously is another 100 basis points off by the end of next year. The market is pricing less than 50 basis points for 25 tonight, and then less than 50 next year. Last year, remember, it was, what's the market looking for? 200 off, and the Fed was saying 50 going into 25. That all reversed. Who's going to catch up with who? I think what I say, I think in discussions individually and when they've had the FOMC, I think they'll have agreed to do one more cut on the basis that they then decide to wait and officially say that they're looking. And I think the language is going to be very important. The market might get spooked a bit on the fact that he actually does say that they're watching and waiting. It shouldn't be a shock, but you know what the market's like. I think that language will be, we've done very well. It's time to just make sure. And I think he will also say that he still thinks rates are relatively too tight, and that they'll try and normalize when they can, as opposed to having to do it immediately. So there'll be lots for people to interpret, and you'll be able to interpret that as being hawkish if you want, and there'll be just enough to get that a little spike in the dollar, I think, which then when everyone calms down, they'll go, well, that's no different to what we already know. Well, it's a safer environment, and they're in a position where they can react if the data goes wrong, et cetera, et cetera. So I think net, there'll be a change officially, but I don't think it should spook the market too much. What do you think? Yeah, often I said a couple of weeks ago, remember, I hate the Santa rally period because everybody's always waiting for it and talking about it, and you just get spooked that it's not happening, and then you cash out and say I'll come back next year, and then they rally the damn thing 3 or 4% at a whim, often getting called up overnight, and it's like, oh, for God's sake. So yeah, I have a lot of sympathy with this time. What would spoil the Santa rally if there is one? Just it's going to be a geopolitical thing, or Russia going early on Bitcoin gold discussion that we had earlier. I don't think there's really much to speak it in terms of outcomes. One thing to watch out for as well as the Fed tonight Micron report often is something that makes, because it's late or early in the next quarter of reporting, people often use its commentary as a good bellwether, so that might suddenly spook everything. Remember, on the basis that we've had the FANGs have been driving the December markets versus the going sideways broad market. Do I think markets are going to crash? Depends how you define it. I think if you've been following what I've been talking about since April, really, it was all about the 3, 4, 5s, big impulsive third wave breakouts with 4s, which are kind of 38% fib pullbacks, and then you get a final move to a new high. But we've been in a series of those at different degrees. We're moving into an intermediate level 1 at the moment, and when that comes into a top in Q1, and that could be late January, I think, we're overdue a decent pullback for a wave 4, which should be of one of those 10% pluses. Now, I'd determine a crash as 20% plus. So you do get lots of 10% plus pullbacks. They're normal. Everyone panics. It is a big pullback. But I do think when that's finished, it's something you want to buy. But I think within that pullback, it's going to be quite choppy. May well be what they call a flat. So you're probably going to have a big pullback, a big rally, another sell-off until that's finished before it finally breaks out. So lots of opportunity this year, which is why, rather than think of it in crash terms, think of it in an increase in volatility. Now, that just means bigger trading ranges for us. We like trading ranges, and there should be lots of opportunities to get on those. So rather than panic out, I think there'll be a transfer of ownership of some key assets, and then we go again. But yeah, there's a 10% ahead, I think, in Q1. That's my consensus for the minute. So at the moment, I don't think there necessarily is. I haven't really checked. I need to go through a lot more charts and find out where the hedge fund positioning is on stocks having been super long. And remember how it was all set up for the volatility breakout post-election. Just how much of that they've unwound, because the VIX has stayed low. That to me suggests that downside protection keeps getting taken off. We're just stuck in a range at the minute, which has got kind of, in terms of S&P, we're 59.50, 61.50 on where all the call options and put options are. They call those put and call walls. So there is an under-over bias with the market makers relative to their gamma positions, which basically means it depends who is long and who's short of that as to which way we go. The reason why you tend to get the rally is that once you start moving towards that call wall, nobody really wants to get caught out, and they'll just roll it higher into the new year, in which case the hedging moves to high levels. It leaves an open gap in the market that the buyers can move into, and it'll seemingly come out of nowhere. So just be aware that this is a time nobody really wants to stand in the way of anything. So if you get any kind of programs coming in, which I do think are in around the bottom side of these ranges at the moment, then they only have to move up their buying tops percentage wise, and that is what will kickstart us moving in. It's always a case of it's not coming, then boom. I might be wrong, but that's how it tends to work. The whole book reading thing. I'll tell you what, that is a much better question to come on to my chat directly. So come on, subscribe to Planty on the sign-ups on the Discord, ask that, because that is a much better question. That's a question much better answered by everyone in the community, because you get a really good mix of what people look at, and particularly people, your peer group, what they find more helpful rather than what I would tell you. And I'd appreciate it if you did that. Thank you, Billy Bot, because that's a good Christmas idea for everybody to think about books, etc. So yeah, if you're not subscribed, you have to go to Get Roll on the Discord, and then you select myself, Riz, Poker, etc., or Analyst. Right, last couple. I can hear dogs barking, needing to get a dog walk. Right. Do I think a lot of households are yet to feel the pinch of high rates? Yes. In the UK, I'm hearing 37% of mortgages are fixed terms or low rates. Yeah, I've had to bite the bullet. I ended up having to take 4-spot 0.5 versus 2-spot 8.8. I expected there to be 2 or 3 more rate cuts by now, which didn't come through, and the relative consequence of waiting wasn't good. So I think there might be a big rollover of people in the new year. Just they're not going to cut tomorrow, and the UK are going to have very limited periods. And as much as I hate to say it, I think Catherine Mann is correct in terms of when they go, they'll go big. So they'll probably have to wait. They'll do 50 basis points as soon as they can, but they need the data to die. That could take 3 or 4 months if they're really unlucky. But it's coming. The data from the HMRC side of things on tax take suggested 38,000 people had dropped off the roster, really, on the back in November on the back of the budget. Really, I think that is, and that it's probably going to get worse. So they might have to start thinking about just bailing out households a little bit relative to a tiny uptick in inflation. Just encourage Taylor Swift not to do any more tours. And then a contraction in GDP as well could be an interesting one. Well, that's another way of what I'm just messing about saying. It's all a mix of how it comes through. If PMIs start rolling over already, they missed massive on the GDP print day. They missed industrial production, construction, manufacturing, and GDP. Blah blah blah. They need to sort out how to get building construction going. That's the big debate that's going on at the moment. And at the minute, there's very little incentive to see investment flows into the UK. So again, the FTSE might just carry on being in this muddled consolidation at the moment. Sterling, by definition, it's going to stay higher for the moment. But consensus has got to be that the Fed cuts tonight and that they go hawkish. And consensus is the Bank of England do nothing, and they're going to stay even longer than the Fed. So we're just looking for relatives around that to change. At the moment, they're not. Will the panic in the euro see even more flows into sterling? You don't know. I'd imagine people go elsewhere. But as I said earlier, just keep in the back of your mind that there might have to be some safe haven flows if things like Brazil suddenly start appearing in Southeast Asia with problems. The more China cuts, unless the stimulus improves everything, then it makes the pegs to the Chinese yuan really painful. And if you've got the US dollar really high as well, then the debt side of things is a nightmare too. And the dollar exchange rate becomes a problem. All becomes self-fulfilling, and that is something that I think external factors might make Q1 tricky regardless of what Trump sets up. So it's all going to be quite tricky, Q1. But we'll work our way through it as it happens. Anyway, if there's no more questions, I hope you enjoyed that. Please come back on my chat with ideas, and hopefully join me next time. And lots of questions, please. Thank you, guys.